Okay, welcome everyone to our second revision class on ATS. So we'll be starting our revision from audit evidence and verification procedure. We all know what evidence is. If you don't have evidence, you can't form an opinion. If you don't have evidence, you're going to struggle to prove your point. So as auditors, it's important that when we go out there to audit, that we have evidence that will help us form an opinion. What type of evidence are we looking for? It's important to note for exams that auditors, to form an opinion, must obtain evidence that meet two key criteria. They must obtain sufficient and appropriate audit evidence. So the keywords here, with regards to the type of evidence auditors must obtain, are one, the evidence should be sufficient, and secondly, is the evidence should be appropriate. So this is what we refer to as criteria of evidence to be collected. So evidence must be sufficient and it must be appropriate. These are two keywords. So sometimes you see questions around what does sufficiency mean, or when we say an evidence that this means what. So when we say sufficiency, we're talking about quantity. You should have just enough quantity. Just enough quantity to form an opinion. So what do we mean by this? So you're going to audit an organization that in a year, they've done over 100 million transactions. And then you pick one that has error of 5 naira. And you say, based on that, you see that the financial statement is not true and fair because of that error of 5 naira. We cannot say that that is sufficient evidence because the quantity or the volume is not sufficient enough for you to form an opinion to say, okay, based on this evidence, this statement is not fine. So we need to get sufficient evidence, sufficient in terms of quantity. Secondly is to say appropriate evidence. So when we say appropriate evidence, we're saying that evidence that is relevant. So sometimes you'd say, okay, an appropriate evidence is an evidence that is dash or something. It's an evidence that is relevant. It's an evidence that has quality. Quality evidence, relevant evidence said to be appropriate evidence. And these evidence are required to enable the auditor form an opinion. So these evidence are required, or the basis for forming an opinion, are required or the basis for forming an opinion. Okay, so the next question arises: what quantity of evidence would be considered sufficient, or what type of evidence would be considered appropriate? That's the next question that you might want to ask yourself in terms of these two criteria. So what determines sufficiency and appropriateness? Or let me not use the word what determines. Let me rather change it to who determines sufficiency and appropriateness of evidence. It is the auditor, based on his professional judgment. So based on this professional judgment, there is no textbook or nobody will tell you that if you are going to audit this organization, you must only check 100 transactions, or you must only check 500 transactions, or you must only obtain evidence through documentation, or you must only obtain evidence through secularization. Nobody's going to, no standard is going to tell you that. The auditor's decision on the quantity obtained or the quality is based on professional judgment. So what do we mean by professional judgment? We mean it is based on the auditor's expertise and experience. So based on the auditor's experience, based on what they've been doing, what they've seen in the course of the job, they can then say that, okay, if I obtain this level of evidence, I am fine. Or if I check ABC, I think it's an appropriate evidence. So the auditor's professional judgment is used to determine sufficiency and appropriateness of evidence. Now, sometimes the auditor might need to seek the assistance of a third party. Let's take, for example, you're auditing, you're a financial auditor. You have very good knowledge about finance and everything, or you're auditing a company that is highly reliant on IT. So you need someone, you need an expert that can provide an opinion on those IT systems, because that is not a key area of expertise. And don't forget, we discussed yesterday that you should not accept a job that you're competent or doing, except you're able to get someone that can do it well for you. So yeah, it's permitted to get someone. But when you get someone to do the job for you, what criteria do you use to determine whether to depend on that evidence? So that's what we refer to third-party evaluation of third-party evidence or experts. So evaluation of evidence provided by experts. Evidence provided by experts. So what are the things you look at when you look at some of those evidence that is provided by an expert? One of the things you look at is you want to evaluate that expert. What is the expert level of competence? Their qualifications, the work they've done before. What is the level of competence? What is the capability? Do they have the resources to do that work for you? And very important too, objectivity. Because we want to be sure that the person you are inviting to come and do that check of IT system is not a relative of the owner of the company. Because once that person has that relationship, it impacts on the work that they are doing. It impacts on the work that they are doing. It would mean that they could tell you that it is fine when indeed it is not fine because of that relationship that they share. Very important that we take note of that as well when evaluating evidence provided by experts. Those are the things that the auditors would do. Now, when the auditor goes to conduct an audit, one of the things that auditors check are what are called financial statement assertions. So we can say that audit involves testing financial statement assertions. So that's another keyword you should be aware of, financial statement assertions. So I'm sure the next thing that will come to your mind would be, oh, what are financial statement assertions? So when we say financial statement assertion, even though they are not written, financial statement assertions are claims that are made by an organization's management regarding the financial statement. So financial statement assertions are claims made by an organization's management claims made by an organization's management regarding its financial statements. That is financial statement assertions. So when you go to audit and the company gives you its balance sheet, they give you its profit and loss and its cash flow statement, without saying anything, what the management is telling you by giving those statements to say that this account we are giving you, we believe that the account meets some criteria. And so they believe that, oh, if they are assets, they are claiming that they are the owners of the assets. If they report revenue, they are claiming that, oh, the revenue exists. It was reported in a particular period. If they're giving you an amount on the statement, the value of an asset, or they're claiming that, oh, that is the real value. So that is what is called financial statement assertions. And those are the things auditors test. So our test is now to look at those assertions, those claims that management has laid regarding its financial statements. So what are these assertions? One, financial statement assertion. One of the things that auditors will check is existence. It's existence. And the key focus on this are assets. So the company reported on its balance sheet that we have motor vehicle worth 5 billion. The auditor would want to check as part of its assertion existence. Do those assets actually exist? And one of the things that auditor could actually do is to say, okay, let's go and physically verify that asset. Another assertion that the auditor tests to gather evidence would be the assertion on rights and obligation. Rights and obligation. So you go to a company, they say we have 10 motor vehicle worth 10 billion. And you go and check, you can see motor vehicle in their garage, and you could value that these vehicles are worth 10 million. But what if those vehicles were just borrowed so that you can come and look and then you go back and you take it as okay? If you check just existence, you might get tricked. So auditors would also want to check that you have the right to that asset. So that's what we mean by right or ownership. So we can call it ownership right or control. Ownership rights / control. So what the auditor will ask is, give me the receipt, give me the purchase document. Let me even see evidence that you are actually the owner. And I look at the document, maybe I compare it to be paid by bank. I collect your bank account. I look at the date you bought it, how much did you pay, and then I look at the receipt. Does it tally? Are you the owner of that asset? So auditor will want to check for your rights to that asset. Alternatively, we set obligation. By obligation, we mean your loans or debt. If you claim your account, for example, that you have loans, so because you have loans, you're paying interest on that loan and you're deducting it from it to arrive at your profit, auditors will want to know, as part of their assertion check, are you obligated? You have the obligation to actually make payment on that loan. Very important. So these two assertions are very powerful assertions when reviewing our balance sheet. Because obviously our assets, physical items that we can check, the balance sheet, our loans, on liabilities and balance sheet. Other assertion that the auditors would want to check is what is called, another one is occurrence. Occurrence. E.g., did the sale actually occur? That's an example of a test of occurrence. So let me give you a example. What companies, some companies will do if they want to report high profit is that they'll claim, they'll record sales as if they sold an item. They will now credit sales. They will debit their receivables that, oh, we sold this item on credit. But in reality, they might not have sold it. Maybe they just push the item somewhere and they're trying to inflate profit. So they record sales. Then possibly years in the future, they might not write it off. They might not write off the receivables as bad debt. So as auditor, you want to check. So when you're talking about profit and loss item, your sales, your expenditure, did they actually occur? So that's another assertion auditors will typically check. Another assertion to take note of is what is called completeness. By completeness, we mean was anything, or say thing, I'm referring to revenue, asset, income, whatever. Was anything added or omitted? Maybe the company doesn't want to pay tax, so they will omit some of their revenue so that they report very low revenue for tax purpose. Or maybe on the other hand, they're trying to make their profit look good. So some of the expense that they have incurred, they omitted it. So as auditor, when we test or check, we conduct with regards to our financial statement is the completeness of the items that are on it. We also want to look at other assertions quickly, assertion of valuation and measurement. So some financial statement figures involve that we assign values to those items. So we want to be sure that those items are correctly valued in line with appropriate accounting standards. Another assertion you want to check is presentation. So we don't want to have a situation where current asset is put under fixed asset. Fixed asset is put under current asset. Or situations where loan is recorded as revenue, or revenue you get it as loan. So we want to ensure that all items are included in the right class. So all transactions are included in the right class of account. That's what we mean by a presentation. So that's what I think the auditor will check in conducting the audit. And then one more that the auditor would check in conducting the audit is what is called disclosure. All items meant to be disclosed actually disclosed. So in accounting, you realize that you're expected to disclose certain things in your notes to account. So we want to be sure as auditor that if there's anything that we need to disclose to the owners of the business, the members of the company, that is appropriately disclosed. So these are the things the auditors check, which is referred to as assertion. Those are referred to as assertion. So what technique does the auditor then use to test these assertions? That becomes the next part of our consideration. What techniques? What techniques is used to obtain audit evidence? Is used to obtain audit evidence. For example, if I want to check if an asset exists, what technique will I use? If I want to check even if it's complete, transactions are all recorded in the account, the code, the value is fine. What are the techniques, general techniques that auditor will use to obtain audit evidence? Now, there are a number of techniques. First technique we want to take note of is what is called observation. To observe means to look. So you're going to look. That's my observe. Let's look around. Let's observe what is happening. How do they do things? Can I see the asset? Can I look at it? Can I look at how they typically do their things in the organization? That is what we mean by observations. When you observe, you see something, you are able to form evidence. Maybe snap what you've seen that serve as your audit evidence. So observation will involve looking, and the main focus here will either be looking at processes, how people do things, or physical items. So you can then from there know that, oh, this evidence I have from this stuff. That's the first. A second technique an auditor would want to use to obtain evidence is called inspection. By inspection, we mean checking and verification of documents. So the auditor provides you with some documents to say, okay, these are the evidence that we have, our receipts, our purchase invoices, our sales invoice, our asset register. We inspect those documents, and then we're able to get evidence out of it to form an opinion. A third option auditors might want to take to get evidence is through confirmation. E.g., external confirmation. External confirmation. And the technical term for it, when an auditor seeks confirmation of certain figures in its financial statement from external parties, the technical term for it is called secularization. Secularization. So, for example, the company the auditor looks at the company's books and says in the book that they said they've sold goods worth 100 million to Mr. ABC. They decide to write to Mr. ABC to confirm. In reality, did you buy goods worth this amount from so person? That is referred to as what? Secularization. And that is a method that auditor would use to obtain evidence. So when the other party responds, they're able to compare the value or the information provided by that party against what they were informed by the organization. Another technique is called reperformance. So sometimes they call it reperformance and accounting. Reperformance and accounting. So what do we mean by reperformance? The auditor has given you the bank statement. You said, okay, let's redo it ourselves. Let's redo the bank statement ourselves. Or the client gives you their general ledger and gives you the trial balance. You say, okay, let me use the general ledger and even prepare my own trial balance. That is what reperformance. So that is redo what has been given to us. So when I do my own bank reconciliation, I can then compare it with the bank reconciliation statement that the company gave to me. And then I will then form an opinion on whether they've done the right thing or not. Another technique which organizations would also typically use as well is called inquiry. Inquiry. So by inquiry, we mean asking questions. Of members of the organization, large employees. So let me use the word employees so that we don't mix members with owners. So asking questions of employees. of the organization. So these are the different techniques auditor would adopt to obtain evidence that would help them provide an opinion on the mentioned assertion. Now, it is important to take note. It is important to take note that inquiry on its own is never a sufficient evidence. On its own is never a sufficient evidence. As it must always be validated, as it must always be validated. So what do we mean by that? Go to a company to do an audit and you ask them, what is your inventory level? What quantity of items do you have in your inventory? The store manager says we have 50 vehicles left that we've not sold. And then you then write it down on sold vehicle 50 and you leave. You've not done anything. Because inquiry on its own is never a sufficient evidence. How sure are you that they didn't lie to you? So you need to do something else. You said, okay, 50 vehicles, oh, that's fine. Please, can we go and count? Please, can we go and check? I need to check and verify. So please, you should take note of it for exams. And when it comes to evidence hierarchy, inquiry on its own is never a sufficient evidence. It must be done in combination with other forms or other types of evidence. There's also something you would also want to take note of in terms of evidence. That involves the company's or the auditor's use of management representation. A, B, C, D, E, F. Okay, let me call it G. Management representation letter. Management representation letter. By management representation letter, you're trying to put the company under oath or under a tight position. Tell them, okay, you want to audit your bank statements or your values of the bank. Please put it in writing. Confirm to us in writing that these are the exact bank statements you have, and these are the account numbers, so that in case anything goes wrong, we can hold you by your word to say you mentioned to us that these are the bank statements that you have. Now, for you to use a management representation, I'm going to ask the company to give you management representation on anything. It's only done where other sources of evidence are less reliable, or you cannot get other sources of evidence. For example, an auditor, you typically will not be able to get the bank account of all your customers without asking them, except you want to go through maybe using legal means, which might not work for you. So in situations like that, that is when we use things like management representation letter. It could also be in terms of maybe some valuation assumption that the company makes in arriving some values. When you think that the only option you have is to rely on them, get them to give you a management representative letter to say that what we've given you is what it is, and we are committing to it being the truth. So that in case anything goes wrong, you can hold on to them. Well, it's situations where you can actually get that evidence yourself. You can check, you can verify. The management representation letter is not appropriate. So management representation letter typically be sought to provide evidence, we sought to provide evidence in areas where the auditor might have less reliable sources. So said management representative letters is sought to provide evidence in key areas. Key areas where other sources of evidence, may be less reliable or non-existent. May be less reliable non-existent. So this question, with this explanation, can the auditor use management representation letter to validate that an asset exists? I want to hear you guys' voice. I want to hear people's voices. What I just said now, can the auditor tell the company, please put it down for me in writing that an asset exists and use that as evidence? Would that be sufficient?
No, sir.
Definitely no, because we said that it's only in situations where other sources of evidence are less reliable or they don't even exist. Why would I ask you to confirm for me when I can say, please take me to the assets and let me look at it? What I see with my own eyes,
yes,
what I can rely on is what I can see. As against when I say, how many bank accounts do you have? I can't go anywhere except you give it to me. I can't go except I want to try going to court to get court order to go to the bank to then get your bank statement and get your account list. But outside that, I won't be able to get that information. So please take note of that with regards to management representation letter. Now let's quickly discuss a few other things so that we can move on from this topic. We spent quite some time here. Let's look at reliability of evidence. Reliability of evidence. Two things you need to note. A is that oral evidence is the least reliable source of evidence. Them say, he said, he told me that, you're on your own. So oral evidence is the least reliable source of evidence, especially when you are the only one. There's no other person that was there with you. There was no recording or anything. So oral evidence is the least reliable. So just please try as much as possible to avoid oral evidence, the least reliable source of evidence. That is very important. That goes to show, in essence, that that goes to say that written evidence is more reliable than oral. So written evidence is more reliable than oral. So that's one thing you should note about reliability of evidence. Second thing you should note is that originals are preferred to photocopies. Very important. So when you're doing their audit and they bring you photocopies up and down for everything, please decline it. You want to see the original. It is easier for a photocopy to have been tampered. In other words, they have taken the original, they edit it, and get that photocopy out of it. So we don't want photocopy. We want to see the original documents. So original documents are more reliable than photocopies. C, yesterday we talked about internal controls, the system that have been put in place to address risk. C, in terms of reliability, take note that audit evidence is better if there is an effective internal control system. Audit evidence is more reliable if there is an effective internal control system in the organization. In other words, if they do things right in the organization generally, we believe more of evidence we get from them than when there are less procedures, people don't abide by rules and regulation in that organization. Another thing to note around reliability of evidence is the fact that evidence that is obtained directly by the auditor is more reliable than that is passed on to the auditor. So evidence obtained directly by the auditor is more reliable than evidence passed on by the client. So let's take a typical example, bank statement. So if you want to a bank statement of the company you're auditing, the bank statement that is sent directly by the bank to you. Bank sends it directly to you. It's more reliable versus the one that the bank will send to the customer or the company will now send to you. Why do we say this? Who knows why we said this? Who knows why we said that evidence bank statement provided to you directly is more reliable than bank statement that is provided to you by the customer or the company you're auditing? That is because this one can be tampered with.
Yes.
Can be tampered with. The guy will just collect bank statement from the bank, edit some things, take out some things that they don't want you to see, align it again, do plus or minus, adjust the balance figure, and they will send it to you. And you think that you are fine. You are fine. That is not knowing that that's bank statement has been offered. So in terms of reliability, what you obtain directly is more reliable. Also, evidence obtained from external source. Evidence obtained from external source. From external source is more reliable than evidence from the client records. Very important. So whatever you obtain from external source, for example, your secularization, when we say secularization means sending out requests for customers, those that have done business with the organization to confirm that those transactions have taken place and the balance that they're owing or they're being owed is correct. So those evidence you obtain directly from external source is most reliable than evidence that you get from reviewing records that the company has given you in its premises. It then begs the question, what is the most reliable source of evidence? What is the most reliable source of evidence? The most reliable source of evidence is evidence obtained directly by the auditor. Evidence obtained directly by the auditor. For example, you're trying to audit whether an asset exists or not. You going there and seeing with your own eyes is more reliable than any other thing. Nobody can tell you any other thing. Does it exist? You went there, you saw it with your own eyes. That is more reliable than, say, you write to the person that sold the asset to ask the person, oh, did you sell the asset to Mr. A? And he said yes. Or you ask the company, do you have this asset? They said yes. Give us the receipt. They give you the receipt. They give you the invoice. They give you the bank statement that shows that they were paid for the asset. All of those ones, they are not as reliable as that evidence that is obtained directly by the auditor itself. So the most reliable source of evidence will be that obtained by the auditor, and the least reliable source of evidence became oral evidence. So that's evidence and evidence, what do you call it? Evidence and verification procedures. And the criteria and the key point you need to note with regards to evidence and evidence gathering. So the number of key terms, like we said, we need to note. Let me quickly highlight them and then we can move forward. One, is number of key things we really need to note on this part. Move out of it. Okay, yeah. So one is what type of evidence should the auditor obtain in terms of, you must meet two criteria, very important that we note that. We also need to note the type of assertion, what the auditor is testing, very important, as long as other things too, very, very important, especially for your theory part of your question. You must know the technique used by the auditor to obtain evidence. We must know situations where management representation letter is used. We must know reliability of evidence. Reliability of evidence is also called sources of evidence. So if I ask questions around sources of evidence, I'll be talking about, okay, sources of evidence could be oral evidence, written evidence, evidence obtained directly by the auditor. Those are sources of evidence. It's very important that we note all of that. The next topic we're moving on to right now is audit testing and sampling procedures. Audit testing and sampling procedures. If you recall, we said yesterday, as part of our discussion, that it's not possible for a group of auditors to check every single thing that was done by the finance department in 365 days. You want to check it, you want to test it in what? In 30 days or 60 days. It's not possible. So one of the techniques that help the auditor to form an opinion based on based on a number of tested items is called sampling. That is called sampling. So basically, sampling is a procedure that enables the auditor, that enables an auditor to form an opinion, about a population based on the result of a sample check. Based on the result of a sample check. So for example, we want to test revenue, we want to determine our revenue. Is it fine? Is it complete? Is it accurate? We may not be able to test or to check all the sales for the whole year. So what we typically do is to take a sample. So we can say, okay, we're testing 20% of the revenue based on our materiality level. So for example, if we had set a materiality level that we discussed yesterday at 1 million, we're going to check all sales 1 million above. Now, based on what we get, based on the result that we get from that sample check, we then determine the opinion we can form. So let's take for example that I do a check of 10 items. And out of these 10 items, I'd say maybe one is faulty. So one will be 1 over 10, which is equals to 10%. So based on this result of this sample, I can say, okay, out of my total sales, I think 10% is not reliable. So whether that 10% is something I can accept, whether it is material or not, will then determine what we should do next. But the key point we're driving at is that sampling is forming an opinion on the population about what we are testing based on selected. But there's a problem or there's a risk with this. That risk is what we refer to as sampling risk. That risk is what we refer to as sampling risk. So what do we mean by sampling risk? So when we sample, we believe that that sample should be a representative of the population. But what happens if, for example, you have 100 items in sales for the year? We now said, okay, out of these 100 items, let's check 10 items. And these 10 items, no error. But the 90 that you did not check, all has error. The 90 that you did not check, all has errors. But the 10 that you selected to check, they were all free of error. So in that situation, you might form an opinion that the financial statement based on that sample is okay. But in reality, is it okay? Is it okay? Who wants to help me out? Do you think it's okay?
No.
Not okay.
Yes.
It's not okay. That is the problem with sampling. So when we say sampling risk, it basically arises from the probability. Sampling risk arises from the probability that the auditor's conclusion based on the sample, that the auditor's conclusion, based on the sample or based on what you've selected may be different if you have tested the entire population. May be different. May be different from the conclusion that would have been reached. It would have been different from maybe different from the conclusion that would have been reached. That would have been reached if the entire population, were subjected to the same procedure. That is sampling risk. Very important that we know what sampling risk is. Very important. So if I had tested the whole 100, I would have seen that 90 out of the whole 100 is bad. So I would have reached a different conclusion as against if I had done that sample. So sampling risk is that's what the problem is, because we can't test everything the truth, but we acknowledge that there's a possibility that that sample you choose may not be representative of the population. So before I continue further, because I've mentioned sampling risk, it's also important to quickly explain what non-sampling risk is. So that just in case you need to differentiate between the two, it's easy to quickly do that. So non-sampling risk. This arises from the auditor forming a wrong opinion based on other factors. Based on other factors, e.g. lack of experience. Are not linked to the sample site, to the sample collected. It's very important to know the difference. That is non-sampling risk. So you're forming a different opinion, but the sample you collected is actually fine. It's representative of the population. If you have done the right test, you've done the right thing, you would have been able to detect where there's a problem. Or maybe because you're not experienced, or maybe because you were tricked by the company, you're not paying attention, you didn't exhibit due care in your work, you missed out. So if you missed out and formed the wrong opinion for any other reason outside the fact that you picked the wrong sample, that is referred to as what? Non-sampling risk. Now, there are two approaches to selecting samples. So I want to select, so for example, I'm trying to determine if all employees that leave the organization have their username and password disabled. So we don't have people that are posting, people that have left the organization posting transactions to our account. So one of the things I would do is to get, okay, how many people have left the organization the past 1 year or 2 years, depending on the duration I'm testing. And then I select a representative, a number, a sample out of it from which to form an opinion. So there are two broad approaches to selecting samples. There are two broad approaches to selecting sampling. So approaches to selecting samples. The first approach is what is called statistical sampling. Statistical sampling. The second approach is what we refer to as non-statistical sampling. So sometimes you have question that says, what is the difference, or explain this concept. So my question would then be, what is the difference? What is the difference between a statistical sampling approach and a non-statistical sampling approach? For a sampling approach to be called statistical, it must meet two criteria. Statistical sampling. Statistical sampling must meet two criteria. Statistical sampling. They must meet two criteria for us to say that that approach is a statistical sampling. If it doesn't meet those two criteria, then it is a non-statistical sampling. One criteria is the fact that all items have a chance of being selected. All items have a chance of being selected. So that is one one feature that must exist for us to say that that approach is statistical sampling. If from before you even select, some data don't even have a chance at all of being selected, then that is not a statistical sampling technique. The second criteria is that statistical sampling techniques makes use of probability theory to evaluate the sample results. So the use of probability theories to evaluate sample results. So any sampling technique that does not meet this criteria is non-statistical. So non-statistical is based on judgment, based on the auditor's judgment, and do not meet these two criteria. So those are the two broad approaches. With that said, let's now look at the selection methods. We said, yeah, the approach broadly is statistical and non-statistical. But let's now look at the selection method. As we look at the selection method, some of the selection methods will be statistical and then non-statistical. So let's look at the selection method. The first selection method we want to consider is called random sampling. Random sampling. That's the first method, random sampling. By random sampling, we mean, for example, that, okay, I need to sell, I have 100 items. I need to select 10. So maybe we write, if we're using computer find, if we're using other manual method, we can just write the numbers of those assets in a box, put them together, we shake, and pick out the numbers we need. That's random. So we're picking out what we need randomly. And so you can pick anyone. So it's more like those that watch football when they are doing draws. You see that sometimes they have all of those teams in a bucket. So the guy comes in, shakes, and pick out one. That is random sampling or random picking. And in that box, all of those items are any of them could have been picked. Any of them could have been picked. So if you adopt that approach, it is referred to as random sampling. When you have random sampling, we're basically saying that all items in the population have an equal chance. All items in a population have an equal chance of selection. Have an equal chance of selection. Most auditors, in adopting random sampling, they always make use of what we call random number tables. They make use of what we call random number tables. So that is a term to take note of what can be used to implement random sampling by an auditor. So that is random number tables. So that is one selection method. Another selection method. So obviously this is a statistical approach. This is a statistical approach.
Yes, sir.
Another selection method, taking what is called systematic sampling. Systematic sampling. So by systematic sampling, we mean using a constant interval between selections. So I will explain that further. So basically, this involves selecting items using a constant interval. Selecting items using a constant interval between selections. Okay, between selections. So how would it typically work? Let's assume, for example, that I have a total population of 20. And I'm looking at a sample size of, say, 5. So what I would just do in systematic sampling is that I would say 20 divided by 5, which is equals to 4. So I'm going to pick my samples at each of those 4 intervals. What do I mean? Let me arrange my population. I'm having 1, 2, 3, 4, 5, 6, 7, 8, 9. Oh, sorry, let me write it closer so that I have it on one line. So there are 20. I need 5 sample size, and I've determined 20 divided by 5 is interval of 4. So you see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So my systematic sampling gives me an interval of 4. So what I'll do is I'll pick this one I'll pick this next 4, which is 8, the next 4, which is 12, the next 4, which is 16, and the next 4, which is 20. So that is 1, 2, 3, 4, 5. So that gives me what? My sample size. That is a systematic sampling technique. Very important that we get to note that, go to note that as well. A systematic sampling technique is statistical. A third technique that organization could use what is called stratified sampling. Stratified sampling. So by stratified sampling, basically means that in stratified sampling, the first step is to divide your population into subgroups. And that subgroup is called strata. So we call that strata. That's a technical term to note. We call that strata. Then each strata is then subject to random sampling or interval sampling. The strata is then subjected to random sampling or systematic sampling. Okay, so what do we mean by this? So this is what we mean. You're trying to do an audit of an organization, and you're looking at let me something more relatable. Look at an organization, and then you're looking at products that are, the organization has different products. So they have total revenue made up of different products. So they could have, okay, maybe production of cement, production of food, production of biro. So instead of doing a random mix of everything, we don't want to ensure, we don't want the situation by if we do random, we end up picking all cement. We don't pick anything that deals with food sales or anything that deals with maybe transportation revenue, anyway, whatever thing they do. We want to ensure that whatever we pick cuts across all business lines. The first thing we do is to group that population to subgroups. Now we look at our revenue and say, okay, all the revenue sales from cement, let's put it in the bucket, let's put them together. All the revenue sales from our food, let's put them together. All the revenue sales from our medical equipment, let's put them together. So all of those subgrouping is called strata. We then go to, after we've done that first, we then now go to each of those groups and say, okay, let's assume that we put them into 3 groups and we wanted sample size of 15. We can say, okay, we're going to pick 5 from each of those groups. So we can go to the cement and pick 5. The 5 we're going to pick from the total cement. We can do random or we can do systematic sampling in that one. We go to the food and pick 5. We go to the medical equipment and pick 5, giving a total of 15. That is stratified sampling. Like I said, that would always do that so that to reduce the chances of us picking all our samples from just one group when we know that that population has a lot of subgroups. And closely related to stratified sampling is what is referred to as cluster sampling. Cluster sampling. So in this situation, just like in stratified sampling, the first step is that the population is divided into clusters, not strata this time, they call it clusters. Population is divided into clusters. Is divided into groups called stratas. These stratas Sorry, not strata, clusters. Sorry, I guess I'm getting a little bit tired. Called clusters. Okay. Into groups called clusters. Okay, so these clusters are then, as a group, subjected, these clusters as a group are subjected to random or systematic sampling. For each cluster chosen, all items in that group are tested. That's the difference between cluster and satisfied. Are tested. So let me quickly explain that again. In stratified, we divide it into clusters. So we have our total revenue. We pack all of those that are for, let's assume we do cement, we put them together. All of those that are for food business, we put them together. All of those that are for, say, medical equipment that we produce, we put them together. Let's assume that our sample is, we then go to each of those ones and pick maybe 5 from A, 5 from B, 5 from C. That is stratified sampling. In cluster, first step is that we put them into groups. So we can say, okay, all of those that are in medical together, all of that are in food together, all of that are in cement together. But when we now come to selecting, our selection will now be on them as a group. So we now say, okay, randomly, which of them do we pick? Do we pick food? Do we pick medical? Do we pick cement? If we end up picking food, we're going to test everything that is under food. That's why it's called cluster. That cluster is tested. That is cluster sampling. Another selection approach, which we should be aware of, is what we call haphazard or judgmental selection. Haphazard or judgmental selection. So this does not follow any rule. It doesn't make judgmental or what or this thing. This does not follow. This does not follow any statistical rule. Does not follow any statistical rule, but rather the selection is done based on the auditor's judgment. It's done based on the auditor's judgment. That's haphazard or judgmental sample, and definitely this is but this is the only non-statistical technique really, or non-statistical method. So they can just say, I want to test the first 5 items. I want to test the first 10 highest items. So if you're not inside that first 10, you don't have any chance of being selected. You don't have any chance at all of being selected. So those are the sampling methods that you should take note of. Sometimes too, you have questions around quickly advantages and disadvantages of statistical versus non-statistical. Let's quickly speak to it for a few minutes so that we can leave this topic. We've been here for a while. So let me speak to the advantages and disadvantages of statistical sampling. And then with that, you then know that for non-statistical. So what do we mean by that? The advantages of statistical sampling are the disadvantages of non-statistical. The disadvantages of statistical sampling are the advantage of statistical sampling. So please take note of that. So let's start by looking at advantages associated advantages associated with statistical sampling. So let's see if we can touch on quite a few of them, and then we can then make a conclusion. The advantage, one of the advantages of statistical sampling is that because we follow a definite approach, the auditor can state, define a level of confidence with regards to what has been tested. So let me quickly write it down. So one key advantage is that the auditors are able to state with a definite level of confidence, because you know that you followed a defined method. Like you can hit your chest and say, I'm confident, for example, use stratified. I'm confident that I've cut across the different products. So the auditors are able to state. Auditors are able to state with a definite level of confidence. With a definite level of confidence that the entire population conforms to the sample result. That's one key advantage. That the entire population conforms to the sample result. That is one thing that you cannot say with non-statistical. So within a stated precision limit, really. In a stated precision limit. That is one very big advantage of statistical sampling approach. The second advantage of statistical sampling approach is that the sample size is objectively determined. Sample size is objectively determined because all items have some level of chance of being selected. So there's no bias with regards to it. Unlike when you're choosing it haphazardly or you're using your judgment, you might not really, you might miss out something that is very, very important. And because we're using defined approach, known approach, the result of the test can be expressed in precise mathematical terms. So the results of tests can be expressed in mathematical terms. D, one big advantage of statistical sampling is that to a large extent, bias in selecting samples is eliminated. Bias in selecting sample is eliminated. Okay, so those are advantages of statistical technique. Let's quickly look at a few disadvantages, and that would guide you in answering questions on whether you're looking at advantages of either of them. So let's look at a few disadvantages. So disadvantages of statistical technique. You would realize that we've said that when it comes to evidence, the auditor depends on his professional judgment. The auditor does the review of what risk is, what is not risky, and does that evaluation all by themselves. So the truth is that in reality, auditing is not mathematics. Auditing is not mathematics. That we're talking about statistics. So auditing has never been a mathematical discipline. Never. You're not mathematician discipline. Never. But rather relies more on auditors' highly developed intuition. That is why an auditor can say, I suspect something is happening here. Or from the way the response I got, I know there's something wrong here. So we have this highly developed intuition. So the way that we're able to point or have a feel for where things can go wrong. So if you don't allow us use our judgment to do that, and you want to subject us to a certain mathematical technique, we might end up missing out on what is really important. Two, another disadvantage of statistical sampling technique is the fact that most people who use it would go for small size because they believe that the method is statistical. So most users of this technique fall into the snare of believing, that because the method adopted is statistical, the sample size is not important. Yes, that's the thing. This may result in picking a small sample size. This may result in selecting a small sample size that may not be representative of the population. So those are key, some of the disadvantages of statistical technique. So like we said, the advantages, just to summarize, the advantages of statistical is equals to the disadvantages of non-statistical. So just change the words and just realign it. And also the disadvantages of non-statistical is the advantages or solution. I'm sorry, I'm saying disadvantages of statistical are the advantages. Sorry, let me quickly write this. The disadvantages of statistical are the advantages of benefits that non-statistical technique provides. Okay, that non-statistical technique provides. So that is sampling. Now, there are a few terms I want us to quickly take note of before I move on to my next topic, which is internal control system. One of the terms I want us to quickly take note of is what we call analytical procedures. I should have spoken that a little bit when I was talking about evidence. Analytical procedures. So by analytical procedures, it helps us to identify any deviation from the norm. Any deviation from the norm or from the normal by reviewing historical data, by reviewing historical data. So what do we mean by this? So let's say, for example, you say, okay, let's do analytical procedure on salaries. Let's have an idea of what the salary has been like. And then you see that 2 years ago, they had 2 employees. The total amount they spent on salary was 10 million. This year, they have only 5 employees and they are spending 30 million. So that begins to raise your question, raise suspicions in your mind that as an auditor, why would you have less employees and you're spending more on salary? That's the advantage of analytical procedure. It helps you to identify anything that changes from what the normal has been for that company by looking at trends. So that's one term we should also take note of for our exam questions as well in terms of an analytical procedure. That term I want us to also take note of before I move is what we call audit program. What we call an audit program. So what an audit program basically does is a document that enables the auditor to establish the procedures for test of details. Establish the procedure for test of details. So that's what an audit program tries to do. Okay, so we've covered 2 topics right now already. We've considered audit evidence and verification. We've looked at sampling and sampling risk. Those are 2 very big topics for exams. So please do well to review it again if you need to, but I'm very sure that we've touched on a very important area that we need to take note of. Let's move on to our next topic, internal control system. Internal control system. When it comes to audit, we said yesterday that when it comes to internal control, the responsibility for control rests with what? Management. The auditor is not responsible for establishing controls in any organization. They are not in any way responsible. Very important to take note of it. Second thing to take note of is the fact that when internal controls are put in place, and when you put all those different activities, all those different controls, they have one key objective. They are to prevent risk from occurring or to minimize the impact of risks. So that's the key intent of control, 2 key objectives. So internal controls are meant to achieve 2 objectives. two objectives, two key objectives. First objective is to prevent risk from occurring. So those things that can go wrong, we want to prevent it from occurring. And to prevent that from occurring, we use internal controls. That is what we refer to as probability of occurrence. We want the probability of occurrence to be 0. So that's our first objective we try to achieve with our internal control system. The second objective is if that risk, if that thing we fear were to happen, we want to minimize the impact of the risk. So these are the two key reasons or two key objectives or primary objective of internal control. Very, very, very important. Now, it is also important to note as well that organizations do not all have the same controls or the same control system. And the truth of the matter is that generally, the bigger the organization, the more comprehensive the controls they would have or they should have. The larger the organization, so the size of an organization plays a role. So the larger the organization, the more controls expected. Let's take note of that. Now, it's also important to note that auditors, as part of their review, will check for the control system in an organization. Why do they do this? That is because the level of controls in the organization determines how much sample or how much substantive test sample you should select for substantive test. So we can say that auditors rely on internal controls to reduce the amount of substantive testing required. The amount of substantive testing required. So what do we mean by substantive testing? So substantive testing basically means checking the transaction, what volume of sales, how many sales are you going to check, how many expenses are you going to check the receipt, check when it was paid, check if it's about, check the amount, check if it's posted correctly. So that is what we call substantive testing. So substantive testing. Basically your audit of figures, audit of financial statement figures. Your audit of financial statement figures is substantive testing. And the volume of work we do, if I agree that you can't do everything, the volume of work you do is determined by the internal control system in that organization. It therefore means that before an organization starts looking at the figures in the financial statement, it must undertake a test of control. What is called compliance testing. Compliance testing. That was a test of internal control. So when you test the controls, how do they do things? Do they have segregation of duties? Do we have people approving transactions such that one person does not have the right and the power to initiate approve the transaction, take it to bank and pay themselves. Once they do all of that and they are fine, and when they go to the figures in the account, they won't do as much work as they would do if when they tested the control system is poor. It therefore means that the result of our compliance testing or test of controls determines the level of substantive test to conduct. Determines the level of substantive testing to conduct. Now, for control systems, most organizations rely on what is called an internal control framework. So to develop a sound control system, most organizations rely on an internal control framework to provide guidance. Internal control framework to provide guidance. So I'm sure we've all heard of internal control framework before. It provides that guidance to enable organizations to develop a very strong control. So please think of this term, internal control framework. It provides guidance for organizations to develop a sound control. Provide guidance to develop a sound controls. Now, there are so many of these internal control frameworks out there. However, the most common one, which is used by most organizations, and which is also the one that is covered for exam, what we call the COSO, internal control framework. The COSO internal control framework. And this framework is made up of 5 components, which we should all know. The first component is the control environment. By control environment, we basically mean what is the overall attitude? What is the overall action? Or what does the overall action of management say about its attitude towards internal control? So by control environment, we basically say the overall attitude of everyone in the organization, that is including management really, towards internal control. So is it an organization where once you mention internal control, people frown, people are not willing to do the right thing, you just want to cut corners and move on? Is that what it is? If that is what it is, then it's not a sound control environment. It's an organization where management is always looking to boycott. They have a separate rule for management and a separate rule for every other person. Or is it the same rule that applies to management that applies to every other staff? So that if you can have an environment where everybody has the same consciousness towards doing the right thing, nobody's above the law, you can say to have a good control environment. The other components are risk assessment, which we discussed yesterday. They take out time to assess things that can go wrong. They evaluate it. They try to evaluate what are things that can go wrong. A third one is control activity. By control activities, we mean actions or controls that are implemented to either prevent risk or minimize its impact. to either prevent risk or minimize its impact. That's our third component. Our fourth component is information and communication. Information and communication. So people should be regularly communicated to on the right behavior, on policies, on what they need to know, what they need to do, the penalty if they don't do what they need to do. And then finally, it's important that we continue to monitor, which is our monitoring activities. So for an organization to have a sound control system, these 5 components must exist and they must take it seriously. Now we're talking about controls. And a key part of control is control activity. That was actions that organizations put in place to be able to address risk. So let's briefly look at some of those controls. So key controls to be aware of. Key controls that you must know. So key controls that you must know. So these are activities that organizations have put in place to address risk. The first control is what is called, which is the most common, is what is called segregation of duties. By segregation of duties, we mean that we need to separate tasks. Don't have one person do everything. Don't give one person too much authority in such a way that they can start the crime, they can finish the crime, and they can cover up the crime themselves. So give people different tasks so that if one does something, someone else can detect it. Now, by best practice, there are certain activities that is always recommended that organizations segregate. And that you can remember that using the mnemonic races. That's just the mnemonic we used to remember that. First is recording. The person who records the transactions in an account, who posts the transaction in the account, should not be the same person who is responsible for authorizing it. Should not be the same person. Also, if that transaction involves physical item, maybe an asset or something, the person that is posting, the person that authorized it, should not be the same person that is holding on to those items. The custody should also not be the same person that is approving it, that is executing it. You approve a job for yourself and you still carry out the job yourself. You know, it provides room for a lot of things to happen. It provides room for a lot of things to happen. And finally, it also ensures that your system operations, your daily system operations should be segregated from system development. So one of the major causes of fraud is because there are no inappropriate segregation of duties. You don't give people assigned duties to people in such a way that there is no conflict. So it's very important, very important. A second control is what we call physical controls. Physical controls. By physical control, we mean activities to control access. Control access to your physical assets, and resources. For example, in most places you want to go, there's a security guard. So that is the physical control, because that security guard is able to check can validate your identity before allowing you to come inside the building. Sometimes you have barbed wires or electric barbs in a building. That is physical control. So anything that is put in place to control or restrict unauthorized access to your physical assets and resources is a physical control. So you could have an example. So, okay, which of the following is a physical control? Anything that prevents people from entering or accessing your building or doing bad things in your building is called physical control. Sometimes you also have your CCTV too as physical controls, because it prevents people from stealing things in your building. When they know that it's CCTV, they are deterred from doing things they're not meant to do. A third control that we should be aware of is called authorization and approval. Let whatever people do be approved by someone else. And one key principle is the fact that approvals should be subject to limits. So what do we mean by subject to limits? You work in a company, want to buy biro, a pack of biro worth 5,000, or I don't know what the pack of biro is, but let's say 10,000. I can have my direct supervisor approve it. I want to buy a laptop worth 1.5 million. Maybe my direct supervisor should not be able to approve it. Maybe my direct supervisor can approve anything from 0 naira to 1 million. So once it's above 1 million, maybe my direct supervisor, maybe the divisional head or the head of department will approve that. We then say, okay, anything from 10 million, okay, maybe the VP, vice president, or the vice deputy CEO would approve. Okay, anything above 1 billion, the CEO has to approve. So that's what we meant by subject to limit. You cannot give a blanket approval to say any amount anybody can approve. You're looking for trouble. You will not find anything again in your organization. So it's important that you grade these approval levels.
Limits.
And limits, by assigning limits. A fourth control which organizations use to either prevent risk or minimize the impact, what we refer to as management controls. Management controls. Now, the focus on management controls for our exam is basically focused more towards approved policies and procedures, even though it has a broader meaning anyway. But for exam, and this is what we're meant to focus on. Approved policies and procedures by management. Approved policies and procedures by management over or to direct activities in the organization. Direct activities in the organization. That is one you should also take note of. Another control is supervisory controls. Let's have someone supervise the activity of another person so that people don't just do things, there's no supervisor. That's why you could see that most organizations, they always be head of something, head of this department, head of this unit, just to supervise supervise the activities of those and review their work. Another key controls is the use of organizational structure. Organizational structure and reporting lines. That is also a control. Organizational structure and reporting lines is also a control. Let's take a typical example that you go into an organization and you see that the head of audit in that organization is reporting to the head of admin. The head of audit is reporting to the head of admin. And meanwhile, don't forget that audit will audit admin. So in this situation, what will happen? What will happen is that whenever audit audits admin, they will not want to include any indicting observation because they know that that report is going to the Alga, the head of admin, and they want to get promoted. So this kind of structure is faulty. It doesn't give room for people to do the right thing, but rather it provides for people to connive. So organizations want to ensure that when they place people, that they use proper organizational structure. Very, very important. Would also, as a control, have what is called arithmetic and accounting controls. Arithmetic and accounting controls. Basically, we're saying that if the values, if you use an ERP system, the values, when you add up the values, when you sum, are they accurate? Or is it a situation whereby people will put in 5 plus 10, giving them 50? So that is going to be ensured that all those computations that we use, that they are accurate. Then the final control I want to talk about in this section is what is called personnel control. So by personnel control, mean that as an organization, your recruitment process should be right. If you recruit people based on who you know, without paying attention to competence, you end up finding an organization where people just do whatever they like. So keep control is your recruitment process should be right. People should be trained. Give priority to training and also compensate people, because if we don't compensate people, after a while, they start thinking of how to compensate themselves by committing fraud. So we need to compensate appropriately. So these are all controls, key controls that you should know and what they mean. Very important. But I'm very sure you get questions on this. You can never get a PE exam without question on controls. It's very important that you know what these controls are, what they mean, such a way that if you have a multi-choice, an objective question, or a fill in the blank, you can always relate which of those controls is which. And if you do have a theory question that speaks to identify controls, you can speak to them. Now, if you pay attention to what I just did, now you see that if you look at the mnemonic, the first letter S, P, A, M, S, O, A, P, taking up just all of those first letters can give you a single, what do you call it? A single mnemonic that you can possibly use to remember what you could call farm soap. That's the first letter from each of those controls. It could help you remember, because there are quite many. There are quite many. There are like 8 or so. So just could help you remember all of that. So that's controls. That is control. So let's quickly move on to the next topic, and then we'll finalize with the last topic in the course. Public sector. So I'll pause for a few minutes for any question up to this moment. I have 2 more topics I want to quickly run through. Are there any questions on what we've done up to this point?
That abbreviation you wrote under that internal control manual.
Okay. What's your question, please, on that?
I don't understand it. So.
Okay, so this is basically
Like,
no.
the network went off then.
Okay, so this is basically a mnemonic to help you remember those controls because there are quite many and they are very regular. What I'm saying is that if you are struggling to remember controls, once you remember PAM, so it should help you. So S stands for segregation of duties. P stands for physical controls. A stands for authorization and approval. M stands for management controls. S, supervisory controls. O, organizational structure and reporting lines. A, arithmetic and accounting control. And P, personnel control. Just to help you remember, that's because I've noticed that oftentimes you have a theory question on this. It was important that we come up with something that will help you guys quickly remember. And that's that mnemonic. Hope that's clear.
Yes, sir.
Okay. Yeah, I have a simple question too.
Okay, please go ahead.
Yes, the reliability of evidence.
Okay.
Yes.
Let me go back to that slide so that in case I need to write something, I could just add it to the slide because I'm going to share this with you guys.
Okay.
So go ahead with your question while I go there. Go ahead with your question.
Yeah, you said the evidence obtained from the auditor is more authentic than the one
evidence obtained by the auditor himself. Is that what you're saying?
Yeah,
so
by the auditor. Yes.
Okay.
It's more authentic compared to the one you obtain from the organization. So the organization, I want to ask, is it the board of director or the shareholders?
Okay, so as an auditor, you don't audit is focused on the organization. So when you go to audit, the organization, management of the organization provide you with documents. So when I say the client, I'm saying management of that organization.
Okay, it's okay.
So you're going to interfere with the accounting department, maybe the CEO and the accounting department. So you ask the accounting department, for example, okay, we need bank statements. Or saying that if you are able to tell the bank to send that bank statement directly to you, you would have more confidence in yourself that this bank statement is fine, as against asking them to give it to you. So they will collect it from the bank and give it to you. The risk there is that when they collect it from the bank, they can change some things before giving it to you.
Yes, that's okay.
All right. Okay then. Okay, so there are no further questions. Let's quickly run through our last two topics very, very fast. My time is far spent. Okay, so public sector assurance. So when we say audit, oftentimes our focus goes more to audit of private company. Like we said, when it comes to private company, the objective is to provide assurance to the owners of the business that the figures that have been reported by management is fine, is true and fair. That is a financial statement audit. When it comes to public sector, the primary focus is value for money. That is the primary focus of public sector audit. And that's what differentiates public sector audit from private sector. All other principles are the same. Sorry, just a minute, please. Okay, Yeah, so I'm saying that is what differentiates public sector from a regular financial audit. Public sector focuses on value for money. When we say value for money, the audit is focused on three key areas, which is called the what we call it, called the E's, the three E's. Focus, of value for money audit is on three key areas. Three key areas. And the key areas are: one, economy. B, efficiency. And C, effectiveness. Now we must know what these key areas or these three E's are, because that's where the focus is for public sector audit. So let's begin by looking at what economy focuses on. When you're looking at economy, you're auditing public sector, and your focus is on economy. Question you're asking yourself from your review is, are the appropriate quantity, because government establishment is not there to make profits. You're not auditing profits. Well, the first thing you're auditing is the economy, at the appropriate quantity and quality of input, but at the lowest cost possible. You know very well that in government, when it comes to public procurement, there's always this concern of buying something at inflating the cost of projects. So a public sector auditor would focus on those procurement, those contracts. Are they being, considering the quantity and the quality, are they happening at the lowest cost possible, or are they inflated? So that is the focus. But when it comes to the method to gather evidence, all the things we've discussed, they are applicable. It's just that this becomes our focus. The second part is efficiency, which focuses on our use of the input. So how well, we're asking the questions, how well are inputs, you know, what the resource we use? How well are these resources converted into outputs? And thirdly, effectiveness. We said we're going to embark on a project to help us reduce traffic on the way. So we're trying to divert, get another road or plus what have you. Does it achieve this objective? So that would be effectiveness. How well do these outputs achieve objectives? How well do these outputs achieve objectives? So those are the key, one of the key areas, what do you call it, when it comes to value for money or public sector auditing. It's more focused on value for money, and it tries to address those key areas. Now, when you're conducting value for money, there are specific steps that is recommended for public sector auditing. So I refer to it as phases in value for money audit. The first step is proposal, the proposal phase. That's the first phase. By proposal, we're trying to justify the expense. So justifying expense or project. So we make a proposal to say, okay, this is why this expense is needed, and this is what needs to be done, and the likes and the likes. And the advantage of embarking on an audit with regards to that. The second step is this scoping phase. So we try to look at our review, if we're conducting an audit, to say which areas will be covered in this audit, which areas will not be covered in this audit. And once we determine the areas that are going to be covered by audit, we then go ahead and do a detailed planning. Okay, so when I say justify the expense of projects of auditing the public sector arm or body. Okay, then we then go ahead to do a planning phase. And once we're done with that, we can then go ahead to conduct the actual audit, which is called implementation phase. After our audit, we're able to evaluate to see if we're able to improve the public sector organization by our activity. So we do our evaluation phase, evaluate the results of the audit. Of the audit. So those are just the key areas you should really know in public sector. Most of the principles that we've discussed on regular audit apply. The same rules applies, except for the fact that public sector is focused more on value for money. So any other question around controls, around risk, around evidence, it also applies when we're conducting a public sector auditing. With that, I want to move on to our last topic. IT-based assurance. IT-based assurance. Computer systems now, accounting, keeping of records, postings are all done via the computer. And so as auditor too, it's important too that we also upgrade by also making reference to computer system when conducting our audit. So when an organization uses IT-based systems, so we an organization systems are IT-based, not manual systems, highly computerized IT-based. As auditors, we cannot observe now. We cannot be looking. We cannot be looking. They might not work for us. We cannot be looking. We might not be able to inspect much because they might not have physical receipt everywhere. So in situations where an organization is strongly IT-based, in that situation, specialized techniques of obtaining evidence may be required. Specialized techniques of obtaining evidence may be required because it's off our normal technique. And these specialized techniques are what we refer to as computer assisted audit techniques. Computer assisted audit techniques. CAT. So these are the specialized technique I refer to as computer-assisted audit technique. So if you look at the word computer-assisted, in other words, we're saying we're using computer to assist us in conducting our audit. But let's give a formal definition to it, because oftentimes these days we tend to have questions on cards a lot. So when we say computer-assisted audit techniques, CAAT, what do we really mean? We basically mean any technique whatsoever, any technique that enables the auditor, any technique, whatever the method is, whatever technique it is, but any technique that enables the auditor to use IT systems and computers and computer techniques as a source of generating evidence, and computer techniques as a source of generating audit evidence. That is our computer-assisted audit techniques. Very important that we know this. And there are two main types of cards that you should be aware of. One is audit software. So we have some audit software that you can use for your audit. Some of them that I have personally used before, which are also is ACL, that computer-assisted audit techniques. There's another one they call IDEA. There's one they call high software. These are audit audit software that auditors would use. Second technique is called test data. What we call test data. Test data. It's important that I define test data, because sometimes people get to mix it out when they see it in question. So when we say test data, it basically involves the auditor processing a sample transaction, involves the auditor processing a sample of data through the IT system. So for example, the auditor comes and says, okay, I want to test how your IT system works. You now do some transactions through those IT system. Whatever result they get from that IT system, they compare it with what they would have gotten based on predetermined results. So through this IT system and comparing the results obtained with predetermined results. So for example, I want to check test data. I want to check if your Excel works well. I could say, okay, I want to check the composition of Excel to keep it very simple. I could say manually, I know that 5 plus 5 is equals to 10. So I can go to Excel and say equals to 5 plus 5, then I press enter. If it gives me 10, I know that that test that I've done aligns with the predetermined, what we call a predetermined result. Determines with the predetermined result. Very, very important. Very important that we do that. Very important. Okay. Let's now look at quickly, because I want us to quickly round up this part quickly. Advantages of test data. So advantages of CAT, not test data, advantages of CAT, computer-assisted audit techniques. One is the fact that it enables the auditor to audit specialized IT systems. Enables the auditor audit and obtain evidence on specialized IT systems used for financial reporting. That's one key advantage. Secondly, the fact that with audit software, almost 100% of the population can be tested. So unlike our manual sampling, where we'll be struggling to say, do we do 10 out of 100? Do we do 20 out of 100? If you use your ACL, you can just audit everything quickly, sort, spool, compare, and the like. So with audit software, almost 100%, or let me say virtually 100%, or let me rephrase it and say audit software can permit up to 100% test of the population. Very important. And then, okay, then I should stop at that. For advantages, you can read more on that. For disadvantages, cards also have some disadvantages. Some of the advantages, so disadvantage is the fact that purchasing or developing the program is expensive. Most of these cards are really expensive. So purchasing or development of the application can be expensive. Can be expensive. And the truth is, even after you've purchased or you've developed, your cost does not end there. It requires regular updating. It's required to keep the application up to date. Third thing is you need special training, so specialized training of the auditor. It's required to be able to use those software. IT-based controls quickly. IT-based controls. So basically, when it comes to IT system, there are two main types of controls. One is general controls. So general controls looks at the controls that have been developed to protect our IT environment in general. Second class is what is called application-based controls. So for each specific application that the company has developed and we're doing an audit, it needs to have certain controls. And these controls should be focused around input, should focus around processing, and focus around output. So please read a little bit more on this. Read a little bit more on this, but just take note that their input, their output, and their processing. So the input controls basically aims to ensure that the right data is imputed into the system. So input controls basically aims to ensure that the right data is imputed into the system. And that is why sometimes when you're trying to fill a form on an application and under phone number, you put a letter, it will not accept it. That is an input control, because we know that a letter cannot be a phone number. So they have that controls in place. Or you're trying to put an email, you don't put the @ sign. You just say that, oh, the email is not valid. So those are input controls. They are basically meant to ensure that the right data is imputed into the system. We also ensure the processing controls. So that say that when I put 5 + 5, it doesn't give me 100. That's what processing control is all about. Ensure that the data is correctly processed. Ensure that the imputed data is correctly processed. And finally, the output controls, which focus on the result from processing, from data processing. Okay, so I think we'll spend quite some time, and this might be a good time to call it a day. So we've done a quick run through of all the topics on a high level. So please, this should guide your reading and your revision the next few days. Number of terms we've mentioned and we've discussed. Please try and solidify your knowledge on these areas. So that will be the end of our session. So I don't know, is there any support you guys need from me the next few days to the weekend, really? So I'd see what I can also do outside these 2 revision classes that we've had. I know I shared a pack that has questions, sample questions I've put together. So I think one of the things that I'll do is that I'll get the solution to those questions and share it to the WhatsApp group. So when you study, try and use those questions as your final revision materials, and then ensure that you get familiar with the answers along with those questions as well. I'll try and put that solution by tomorrow, after work tomorrow, and share it with you guys. So okay. Is there any question?
No question. Thank you so much, sir.
All right. Thank you very much, everyone. Thank you so much, everyone. So we'll continue our discussions in the WhatsApp group then. Thank you so much.
Good night.
Bye.
Yeah.